Topic 2, picking stocks. The next part of your journey is going to come down to building your portfolio or picking stocks in line with your personal financial goals and in line with your risk appetite. So where do you start? How do you choose which of the 100 stocks available to include in your portfolio? Well, one of the mechanisms or one of the ways you can choose is according to the size of the company. Take, for example, Fat Cat Limited, whose share price is trading at 100 Rand a share. Compare this to Built Limited. Their share price is trading at 10 Rand a share. Now, do not make the mistake of assuming that just because it's got a higher share price, that the company is in fact bigger. No, what we need to consider is the market capitalization values of these companies. Market capitalization actually takes the share price and multiplies it by the numbers of shares in issue. It gives you a total value, a total market value of the company, and we use this as an estimate of their market size. So, Fat Cat Limited, let's say they have 1,000 shares in circulation, and Built Limited, they have 20,000 shares outstanding. So now, in fact, when we look at their market capitalization values, Fat Cat Limited has roughly 100,000 Rand in market value, and Built Limited, 200,000. So, in this example, it's in fact Built Limited that is the bigger in size or market value. Now, why do you care? Well, remember, the reason why we're looking at the size of the company is because that's going to give you an indication as to its potential for growth and its propensity for risk. So, according to market capitalization, we can distinguish between small caps, mid caps, and even large caps. Caps obviously being short for capitalization. The small cap companies are typically, obviously, the smaller companies with a lot of growth potential, but bear in mind, growth potential, yes, but not all of them make it. So these are classified as the riskier type of shares. We actually associate small cap shares often to penny stocks. They get their name because you can usually pick them up for less than 10 Rand or so, but bear in mind, they are the riskier type. Right, so the mid-cap shares, well, these are typically the companies that are in their growth part of their business cycles. They, for this reason, are known as growth shares. Not as much risk as the small caps, still some upside potential. So medium risk, medium growth potential. Large caps, well, these are the well-established, financially sound businesses of the economy. The large names that you know and the household brands. We refer to these often as the blue chips, and they're probably the safer of the share choices. So if you are cautious in nature, you'd like to build a portfolio of blue chip shares. More aggressive, willing to take higher risk appetite, well, growth shares, penny stock shares, you can make your portfolio out of these. Another approach to consider when looking to build your portfolio or how to pick stocks is what is called the top-down approach. Now, rather than focusing on individual shares first, this takes some research and deep understanding about the current economy and environment. Then, picking a sector or industry within the economy that is well positioned to do and grow well in the future. Only then, once you've identified the industry that is set for success in the current business conditions, then identify an individual company or share to target. Lastly, a very important tool to be aware of when building your portfolio and picking stocks is diversification. Diversification is a means and ways that investors look to manage, maintain, and even eliminate risk from their portfolios. Ever heard of don't put all your eggs into one basket? Well, the same holds true for your investments. One thing to consider is not to put all your money into the same asset class. For example, spreading it across different assets with different risks, such as some in bonds and then some in shares too. Taking this one step further, you can reduce risks by not putting all your money into one industry or one sector of the economy. And then, of course, diversification means not putting all your money into one share.